Subscribe to our channel and click on the bell button to receive important financial updates faster than anybody else. Friends, welcome to another video on your channel Profit and Equities. Now, equity markets seem headed for volatile times. The economy is facing challenges in the form of rising oil prices, weakening currency, and falling industrial growth. A recent finance ministry report also hints at a slowdown in the economy due to lower private consumption, weak growth in fixed investments, and muted exports. All these factors, along with post-election ambiguity, could contribute to increased market volatility in the coming weeks. In this video, we'll be talking about 4 less volatile stocks with 1-year growth potential, which we can go ahead and invest in such times. Now friends, if you're not already members on Profit and Equities, please click on the join button or on the links present in the description of the video and follow the steps. This will entitle you to member-only privileges on Profit and Equities. Also friends, if you like the content that we produce on our channel, please don't forget to like this video, share these videos, and if you have not already subscribed to this channel, please click on the red subscribe button to do so. This will help you get notified whenever we upload a new video. Please watch this video to know more about these stocks. Now the first stock on the list is Abbott India Limited, which is available at Rs 7,965.35 and the face value for it is 10. The symbol for it is ABBOTINDIA. Now Abbott India Limited is a healthcare company engaged in pharmaceuticals business. The company has a portfolio of science-based offerings in diagnostics, medical devices, nutritionals and branded generic pharmaceuticals. Now analysts are bullish on this healthcare company because of the company's strong debt-free and cash-rich balance sheet, new product launches, expansion in specialty businesses, healthy return ratios and strong parent backing. Now as is evident from the 1-year chart, this company has not really been an exceptional performer and has literally been choppy throughout the entire year. The company is a mid-cap with a market capitalization of 16,925.81 crores. The EPS of 211.92 translates into a price to earnings ratio of 37.59, which is slightly more expensive when compared with the industry PE of 28.30. The price to book ratio of 8.43 is also very expensive. The company has a debt to equity of 0.0259, whereas the return on equity for this company is a very strong number and stands at 0.2433. The dividend yield is 0.82%, whereas the promoter holding is a very strong number for this company and stands at 74.99%. Total debt on the books of the company is 51.98 crores, whereas its 52-week high and low stands at 8,820.05 and 6,320.00 respectively. Now the second stock on the list is Bajaj Consumer Care Limited, which is available at Rs 334.60 and the face value for it is 1. The symbol for it is BAJAJCON. Now Bajaj Consumer Care Limited, formerly Bajaj Corp Limited, is an India-based holding company engaged in the business activity of trading and manufacturing of cosmetics, toiletries and other personal care products. Now according to a report by SPI Cap Securities, the company's plans to double its market share in the hair oil category and strategic steps like micro-segmentation, focus on cost excellence and multi-year transformational program will improve its financials going forward. The brokerage house believes the current valuations are appealing and expects 12% sales and earnings CAGR over 2018-19 to 2020-21. Now as is evident from the 1-year chart, this company has been an underperformer and a lot of wealth has been destroyed here. The company has a market capitalization of 4,935.35 crores, which means that this company is a small cap one. The EPS of 15.33 translates into a price to earnings ratio of 21.83, which is much cheaper when compared with the industry price to earnings ratio of 57.62. The price to book ratio of 10.56, however, is on the high side. The company is debt-free, leading to a debt to equity ratio of 0, whereas the return on equity for this company is a very strong number at 0.2986. The dividend yield is also fabulous at 4.18%. Now one concerning factor is that out of the promoter holding of 66.86%, 70.42% of the promoter's holding is pledged. Now the third company on the list is Gulf Oil Lubricants India Limited, which is available at Rs 904.90 and the face value for it is 2. The symbol for it is GULFOILLUB. Now Gulf Oil Lubricants India Limited is engaged in the business of manufacturing, marketing and trading of automotive and non-automotive lubricants and greases. The company's geographical segments include India and also outside India. Now as is evident from the 1-year chart, this company has not really created any major wealth and has literally been closing the year at almost the same levels that it started in. Its businesses include manufacturing, marketing, and trading of automotive and non-automotive lubricants and greases. According to a report by Yes Securities, the company's significant market share, superior product portfolio, and widened distribution network drive its outperformance. The commencement of the Chennai plant has enabled the company to strengthen its position in the south and east. The brokerage believes that the stock is trading at an attractive valuation and expects 16% earnings CAGR between 2017-18 and 2020-21. Now, the company is a small cap with a market capitalization of 4,506.57 crores. The EPS of 35.70 translates into a price to earnings ratio of 25.35, which is slightly more expensive when compared with the industry PE of 21.77. The book value of 117.82 also translates into an expensive price to book ratio of 7.68. The debt to equity is 0.5171, whereas the return on equity for this company is a very strong number and stands at 0.3373. The dividend yield is 1.27%, whereas the promoter holding is another very strong number and stands at 72.73%. Total debt on the books of the company is 303.4 crores, whereas its 52-week high and low stands at 937.45 and 688.60 respectively. Now, the final stock on the list is DB Corp Limited, which is available at Rs 195.45 and the face value for it is 10. The symbol for it is DBCORP. Now, this media company publishes newspapers in 12 states, runs a radio business in 7 states, and has a digital presence with 9 portals and 4 mobile apps. Analysts are bullish on the stock due to its market share gains, diversified readership base, recovery in ad revenue growth, and stabilizing newsprint prices. Its diversification across geographies puts the company in a better position to withstand rising competition and any economic slowdown. Now, as is evident from the 1-year chart, this company has been a real underperformer and a lot of wealth has been destroyed here. The company is a small cap with a market capitalization of 3,418.87 crores. The EPS of 15.65 translates into a price to earnings ratio of 12.49, which is slightly cheaper when compared with the industry PE of 14.99. The price to book ratio of 1.87 is not wildly expensive. The company has a debt to equity of 0.0644, whereas the return on equity for this company is an average number and stands at 0.1458. The company has a very strong dividend yield of 5.12%, whereas the promoter holding is also a fabulous number and stands at 71.61%. However, a major red flag for this company is the fact that 39.88% of the promoter's holding is pledged. The 52-week high is 287, whereas the 52-week low for the stock is 156.15 respectively. Now friends, please don't consider this to be a recommendation on our part. It is not our own research. We will be providing a link to the source for this video in the description section. Please go through it to build more conviction around your investment decision. Thanks for watching and you have a great day ahead.